Welcome to Alpha Robusta. Today, we're diving into the realm of financial security with our top 10 strategies for protecting your investments. Whether you're a seasoned player in the market or just starting out, these strategies will be your shield against volatility and uncertainty. Today, we will talk about top 10 strategies for protecting your investments. So before we get started, make sure to hit the like button, also subscribe to my channel. 1. High-yield savings accounts. While not technically an investment, savings accounts offer a modest return on your money. You'll find the highest yielding options by searching online, and you can get a bit more yield if you're willing to check out the rate tables and shop around. A high-yield savings account is completely safe in the sense that you'll never lose money. Most accounts are government insured up to $250,000 per account type per bank, so you'll be compensated even if the financial institution fails. 2. Money market funds. Money market funds are pools of CDs, short-term bonds, and other low-risk investments grouped together to diversify risk and are typically sold by brokerage firms and mutual fund companies. Unlike a CD, a money market fund is liquid, which means you typically can take out your funds at any time without being penalized. 3. Short-term certificates of deposit. Bank CDs are always loss-proof in an FDIC-backed account unless you take the money out early. To find the best rates, you'll want to shop around online and compare what banks offer. With interest rates rising substantially in recent years, it may make sense to own short-term CDs and then reinvest if rates move up. You'll want to avoid being locked into below-market CDs for too long. 4. Series I savings bonds. A Series I savings bond is a low-risk bond that adjusts for inflation, helping protect your investment. When inflation rises, the bond's interest rate is adjusted upward, but when inflation falls, the bond's payment falls as well. You can buy the Series I bond from treasurydirect.gov, which is operated by the U.S. Department of the Treasury. The I bond is a good choice for protection against inflation because you get a fixed rate and an inflation rate added to that every 6 months, says Michaela Braden, former senior advisor for the Department of the Treasury, referring to an inflation premium that's revised twice a year. 5. Treasury bills, notes, bonds, and TIPS. The U.S. Treasury also issues Treasury bills, Treasury notes, Treasury bonds, and Treasury inflation-protected securities. If you keep Treasuries until they mature, you generally won't lose any money, unless you buy a negative-yielding bond. If you sell them sooner than maturity, you could lose some of your principal, since the value will fluctuate as interest rates rise and fall. Rising interest rates make the value of existing bonds fall, and vice versa. 6. Corporate bonds. Companies also issue bonds, which can come in relatively low-risk varieties, issued by large profitable companies, down to very risky ones. The lowest of the low are known as high-yield bonds, or junk bonds. There are high-yield corporate bonds that are low-rate, low-quality, says Cheryl Kruger, founder of Growing Fortunes Financial Partners in Schaumburg, Illinois. I consider those more risky because you have not just the interest rate risk, but the default risk as well. To mitigate interest rate risk, investors can select bonds that mature in the next few years. Longer-term bonds are more sensitive to changes in interest rates. To lower default risk, investors can select high-quality bonds from large, reputable companies, or buy funds that invest in a diversified portfolio of these bonds. 7. Dividend-paying stocks. Stocks aren't as safe as cash, savings accounts, or government debt, but they're generally less risky than high flyers like options or futures. Dividend stocks are considered safer than high-growth stocks because they pay cash dividends, helping to limit their volatility but not eliminating it. So dividend stocks will fluctuate with the market but may not fall as far when the market is depressed. Stocks that pay dividends are generally perceived as less risky than those that don't. 8. Preferred stocks. Preferred stocks are more like lower-grade bonds than common stocks. Still, their values may fluctuate substantially if the market falls or if interest rates rise. Like a bond, preferred stock makes a regular cash payout. But, unusually, companies that issue preferred stock may be able to suspend the dividend in some circumstances, though often the company has to make up any missed payments. and the company has to pay dividends on preferred stock before dividends can be paid to common stockholders. 9. Money market accounts. A money market account may feel much like a savings account, and it offers many of the same benefits, including a debit card and interest payments. A money market account may require a higher minimum deposit than a savings account, however. Why invest? Rates on money market accounts may be higher than comparable savings accounts. Plus, you'll have the flexibility to spend the cash if you need it. Though the money market account may have a limit on your monthly withdrawals, similar to a savings account. You'll want to search for the best rates here to make sure you're maximizing your returns. 10. Fixed annuities. An annuity is a contract, often made with an insurance company, that will pay a certain level of income over some time period in exchange for an upfront payment. The annuity can be structured many ways, such as to pay over a fixed period such as 20 years or until the death of the client. With a fixed annuity, the contract promises to pay a specific sum of money, usually monthly, over a period of time. You can contribute a lump sum and take your payout starting immediately, or pay into it over time and have the annuity begin paying out at some future date, such as your retirement date. A fixed annuity can provide you with a guaranteed income in return, giving you greater financial security, especially during periods when you are no longer working. An annuity can also offer you a way to grow your income on a tax-deferred basis, and you can contribute an unlimited amount to the account. Annuities may also come with a range of other benefits, such as death benefits or minimum guaranteed payouts, depending on the contract. Remember, successful investing isn't just about making money. It's also about protecting what you've worked hard to earn. By implementing these strategies, you can safeguard your investments against various risks and uncertainties in the market. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.